Mortgage rates surged to levels not seen since the early days of the pandemic. Mortgage rates have come out soaring in just the second week of the year, reaching levels not seen since March of 2020, a closely watched survey shows. Other new research shows the higher borrowing costs, which most experts say will only continue heading north as the economy improves, are prompting borrowers to lock in today's mortgage rates that are still low by historical standards. 30-year fixed mortgage rates. The average interest rate on the 30-year fixed rate mortgage spiked to 3.45% last week, up from 3.22% the week earlier, mortgage giant Freddie Mac is reporting. Rates are the highest since the week of March 26, 2020, according to Freddie Mac's data. 1 year ago, the 30-year rate was averaging 2.79%, just above the all-time low of 2.65%, which hit during the first week of January 2021. But a lot has changed since then, namely inflation and the Federal Reserve's plan for combating it. The government reported last week that inflation in 2021 shot up 7%, a 40-year high, amid a surge in demand for consumer products and an ongoing supply chain backlog. This was driven by the prospect of a faster than expected tightening of monetary policy in response to continued inflation exacerbated by uncertainty in labor and supply chains. 15-year fixed-rate mortgages. The rate on the 15-year fixed-rate mortgage averaged 2.62% last week, up from 2.43% a week earlier, Freddie Mac says. 1 year ago, the short-term loan were averaging 2.23%. Note that the Freddie Mac numbers are simply averages, meaning higher and even lower rates are out there. Some lenders are still advertising 15-year refi loans at 2% and 30-year refis for under 3%. If you're a homeowner willing to take on a higher monthly payment, you could slash your lifetime interest charges by trading in a 30-year mortgage for a 15-year. 5-year adjustable rate mortgages. The rate on the 5-year adjustable rate mortgage ARM averaged 2.57% last week, up from 2.41% the previous week. Last year at this time, 5-year ARMs were averaging 3.12%. ARMs typically start out with lower rates than fixed rate loans, but after a period of time, an ARM starts to adjust, that is, the rate moves up or down in sync with the prime rate or another benchmark. If you finance your home with the popular 5-1 ARM, which offers a steady rate for 5 years before the adjustment starts, you might want to consider refinancing into a more stable fixed rate mortgage now that borrowing costs are pushing higher. How borrowers are responding to rising rates. Home buyers seem to have gotten the message that rates aren't likely to fall back down. Application for home buyer purchase loan are up, according to the latest report from the Mortgage Bankers Association. At today's 30-year mortgage rates, buyers of a medium-priced home already are paying some $219 more per month than they were a year ago. That's over $2,600 annually. Meanwhile, refinance loan applications from home buyers are at their lowest point since January 2020. Rates at this level are quickly closing the door on refinance opportunity for many borrowers, says Joel Kahn, the lead economic and industry forecaster for the Mortgage Bankers Association. What's driving the higher rates? With inflation at levels not seen in decades, the Federal Reserve has been on the hot seat to temper some of the demand that's led to higher prices on cars, appliances, and other consumer goods. To help put a lead on runaway costs, the central bank recently indicated it would raise interest rates several times this year and stop its pandemic buying of bonds and mortgage-backed securities. If we see inflation persisting at higher levels longer than expected, if we have to raise interest rate more over time, we will, Fed Chair Jerome Powell said last week at the second-term nomination hearing in front of the Senate Banking Committee. Even with the explosion in COVID-19 cases from the fast-spreading Omicron variant, the economy's future continues to look good. How to secure a favorable mortgage rate. If you look out, or if you took out your mortgage when rates were higher than they are today, or if you want to refinance from a 30-year to 15-year home loan, you want to ensure you're doing all you can to get the lowest rate possible. That means comparing offers from at least 5 lenders, which can maximize your savings, or a refi according to research from Freddie Mac and others. Lenders like to see strong credit history. If you haven't looked at your credit or you haven't looked at your score in a while, it's easy today to review your credit score for free. If your credit could use some work, perhaps you've accumulated a bunch of new debt during the pandemic, you might consider rolling credit balances into a low-interest debt consolidation loan. By doing so, you can reduce your interest costs and potentially eliminate the debt faster. And if you are not a candidate for refi, there are other ways to lower your home ownership costs. When it comes time to buy or renew homeowners insurance, flex your comparison shopping muscle again. You might just find a lower rate on your coverage.